Most investors will not understand until it is far too late. It wasn't a price spike. It wasn't a celebrity tweet. It wasn't another breathless prediction about silver going to the moon. It was a policy decision that quietly severed one of the most critical supply chains in the global precious metal system. And if you hold silver, or if you've been watching it from the sidelines, this is the moment where understanding matters more than reacting. Let me be clear from the start. I'm not here to tell you that silver is about to explode tomorrow. I'm not here to promise you riches or to stoke fear about collapse. I'm here to walk you through what actually happened, why it matters, and what it means for anyone who takes their financial future seriously. Because this is not about hype. This is about structure. This is about supply chains, market mechanics, and the kind of disruption that doesn't announce itself with fireworks. It announces itself with a tariff, a seemingly boring bureaucratic policy shift that just changed the physics of how silver moves through the global economy. The details are still filtering through the financial press, but here is what we know. A new tariff policy has been implemented that imposes a 10% levy on certain silver imports and exports tied to Greenland's emerging rare earth and mineral trade routes. You might be wondering what Greenland has to do with silver. That's a reasonable question. And the answer reveals just how interconnected and fragile modern commodity markets really are. Greenland sits at the center of a geopolitical chess game involving resource extraction, shipping lanes, and strategic mineral reserves. As global powers position themselves for control over rare earth elements and critical metals, Greenland has become a leverage point. This tariff is not about Greenland alone. It is about control. It is about who gets access to what and at what cost. And in this case, the collateral damage is the London Bullion Market Association, or LBMA, which serves as the backbone of the global silver trade. The LBMA is where institutional silver is bought, sold, and settled. It is the plumbing of the system. When that plumbing gets disrupted, the effects ripple outward in ways that are not immediately visible, but are structurally profound. This tariff has effectively increased the cost and complexity of moving silver through one of the most important trading hubs in the world. It has not shut down the market, but it has introduced friction. And in commodity markets, friction translates into spread widening, liquidity tightening, and eventually, price dislocation. Here is what you will see in the headlines over the coming weeks. You will see articles that say nothing has changed. Silver is still trading, the LBMA is still functioning, business as usual. You will also see the opposite, panic merchants, claiming this is the end of paper silver, the collapse of the system, the moment everything breaks. Both narratives will be wrong. Because what has changed is not the immediate price. What has changed is the underlying structure of how silver flows through the global economy. And structural changes do not show up in the daily chart. They show up in the mechanics of settlement, in the cost of delivery, in the behavior of institutional players who suddenly have to recalculate their risk models. Most retail investors do not think about these things. They think about the price. They think about whether silver is up or down today. But seasoned market participants think about flow. They think about counterparty risk. They think about whether the system they are trading in is becoming more efficient or less efficient. And right now, the system just became less efficient. That does not mean silver is about to skyrocket tomorrow. It means the conditions are being set for a repricing over time. It means the cost of moving physical silver has increased. It means the spread between paper and physical is likely to widen. It means the institutions that rely on seamless global silver flows are now facing a new variable they did not price in 6 months ago. To understand why this matters, you have to zoom out and look at the forces that have been building in the silver market for years. Silver is not just a precious metal, it is an industrial metal. It is used in solar panels, electronics, batteries, and dozens of other applications that underpin the modern economy. Demand for silver has been rising steadily as the world transitions toward green energy and advanced manufacturing. At the same time, supply has been constrained. Most silver is mined as a byproduct of other metals like copper, lead, and zinc. When those mining operations slow down, silver supply slows down with them. For the past several years, we have been in a structural deficit. The world has been consuming more silver than it produces. That deficit has been filled by above-ground inventories, by existing stockpiles, by recycled material. But those stockpiles are not infinite. And as they draw down, the market becomes more sensitive to disruptions. Now add in the macroeconomic backdrop. Central banks around the world have been expanding their balance sheets for over a decade. Interest rates were suppressed to historic lows. Debt levels have ballooned across sovereign, corporate, and household sectors. When you create more currency units chasing the same amount of real assets, the real assets tend to appreciate in nominal terms over time. Gold and silver have historically been beneficiaries of this dynamic, not because they are magic, but because they are finite, because they cannot be printed or conjured into existence by central banks. Now we are in a period where inflation has reemerged. Interest rates have risen, but remain negative in real terms when you adjust for inflation. Currency debasement is not a conspiracy theory. It is a policy reality. And in that environment, hard assets become stores of value. Silver has lagged gold for most of this cycle. The gold to silver ratio has been elevated for years, meaning silver has been historically cheap relative to gold. That does not mean silver must catch up. Markets do not have to do anything. But it does mean the setup has been in place for a potential repricing. And now, just as that setup was quietly maturing, we have introduced a new supply chain constraint. Now, let's talk about what happens when you add friction to a commodity market that was already tight. First, physical premiums start to rise. The premium is the difference between the spot price of silver and what you actually pay to take delivery of physical metal. When supply chains get disrupted, premiums widen. Dealers have to work harder to source metal. Shipping costs increase, insurance costs increase, all of that gets passed on to the buyer. Second, the spread between paper and physical begins to diverge. Paper silver, traded through futures contracts and ETFs, can still move freely. But physical silver, the actual metal, becomes harder to move. This creates arbitrage opportunities for those who can exploit them. But it also creates risk for those who assume paper and physical are interchangeable. They are not, and in times of stress, that distinction becomes critical. Third, institutional players start adjusting their positions. Large banks and trading firms that provide liquidity to the silver market have to reassess their risk exposure. If it becomes more expensive or more complicated to settle contracts with physical delivery, they may reduce their activity, they may pull back from certain markets, they may widen their spreads. This is not a conspiracy. This is how risk management works. When the cost of doing business increases, participants adjust. And when participants adjust, liquidity decreases. And when liquidity decreases, volatility increases. If you already own physical silver, this development is quietly bullish for your position over the long term, not because the price is guaranteed to go up tomorrow, but because the asset you hold just became slightly harder to access for everyone else. Scarcity is a function of availability, not just absolute supply. When availability decreases, the value of what you already possess increases. But here is what you should not do. Do not assume this is the catalyst that changes everything overnight. Markets move slowly until they move fast. Structural changes take time to play out. Do not check the price every day looking for validation. If you bought silver for the right reasons, those reasons have not changed. They have been reinforced. Do not panic if the price dips in the short term. Markets can be irrational longer than most people expect. Price discovery is not a straight line. What you should do is stay patient, stay informed. Understand that you are holding an asset that is becoming more valuable, not because of speculation, but because of fundamentals. You should also make sure you are holding the right kind of silver. Physical silver in your possession is very different from silver exposure through an ETF or a futures contract. If you do not hold it, you do not own it. That has always been true, but it becomes especially important when supply chains are under stress. If you have been watching silver from the sidelines, this is a moment to pay attention. But it is not a moment to rush in without thinking. The worst thing you can do right now is react emotionally. The worst thing you can do is see a headline, feel a surge of excitement or fear, and make a decision based on that impulse. Instead, ask yourself why you would consider owning silver in the first place. Are you looking for a hedge against currency debasement? Are you seeking exposure to industrial demand growth? Are you trying to diversify away from overvalued financial assets? These are legitimate reasons. And if any of them resonate with you, then silver deserves a place in your portfolio. But you need to understand what you are buying and why. You need to understand the difference between physical silver and paper silver. You need to understand premiums, storage, liquidity, and counterparty risk. You need to understand that silver is volatile. It can swing 10 or 15% in a matter of weeks. If that kind of movement will cause you to lose sleep or make rash decisions, you are not ready. You also need to understand that silver is not a get-rich-quick scheme. It is a long-term store of value. It is insurance. It is a position you take because you understand the macro environment and you want to protect your wealth over time. If you can approach it with that mindset, then this moment, with all its complexity and uncertainty, might be an opportunity. But only if you educate yourself first, only if you go in with your eyes open. One of the hardest things about investing is dealing with uncertainty. We want clarity. We want someone to tell us exactly what is going to happen and when. But markets do not work that way. The future is always uncertain. The best we can do is assess probabilities and position ourselves accordingly. Right now, the probability that silver becomes more valuable over the next several years has increased. Not because of this tariff alone, but because of the confluence of factors that were already in place, now accelerated by a supply chain disruption. But probability is not certainty, and that is where discipline comes in. Disciplined investors do not bet everything on one outcome. They allocate, they diversify, they manage risk. They also stay calm when the crowd panics, and they stay skeptical when the crowd becomes euphoric. Right now, most people are not paying attention to this story. It has not gone viral. It has not captured the imagination of the mainstream financial press. That is actually a good sign. It means we are early. It means there's still time to think clearly before the narrative takes over. But it also means you have to be comfortable acting on information that is not yet consensus. You have to be comfortable being patient while the market catches up to the reality on the ground. If you study market history, you see these patterns repeat. You see periods where a critical commodity becomes constrained, but the market does not immediately recognize it. You see structural changes that take months or even years to fully play out in price. You see moments where the narrative is dismissive, right up until the moment it is not. Silver has been through this before. In the late 1970s, silver went from under $2 an ounce to nearly $50 in a matter of months. That was not because of hype. It was because of a combination of inflation, geopolitical instability, and supply constraints, amplified by large players attempting to corner the market. The lesson is not that silver is about to repeat that move. The lesson is that silver can move violently when the right conditions align. And right now, some of those conditions are quietly aligning again. But the other lesson from history is that most people get it wrong. Most people buy at the top after the move has already happened, driven by fear of missing out. The people who actually profit are the ones who bought early, who understood the fundamentals, and who had the patience to wait. Let me be very clear about what you should not do in response to this news. Do not overleverage. Do not borrow money to buy silver. Do not bet your entire net worth on one asset class. Do not follow anonymous accounts on social media promising that silver is about to explode to triple digits next week. Those people do not have your best interests at heart. Do not assume that because something makes logical sense, the market will immediately reflect it. Markets can be irrational. They can stay irrational longer than you can stay solvent if you are overleveraged or emotionally compromised. Do not confuse volatility with risk. Silver is volatile, but volatility is not the same thing as permanent loss of capital. If you understand what you own and why you own it, short-term volatility is noise. Do not chase premiums. If physical silver becomes hard to find and premiums spike, do not panic buy at any price. There will be opportunities. There will be pullbacks. Patience is a competitive advantage. Do not ignore the rest of your financial house. Silver is a piece of a diversified portfolio. It is not a replacement for emergency savings, retirement planning, or sound financial management. And most importantly, do not react emotionally. Fear and greed are the two emotions that destroy wealth. Discipline and patience are the two habits that build it. Zoom out for a moment. We are living through a period of profound economic and geopolitical transition. The monetary system that has been in place since the end of World War II is under strain. The dollar's dominance is being challenged. Central banks are exploring digital currencies. Debt levels are unsustainable. At the same time, the world is undergoing a massive energy transition. The demand for critical metals, including silver, is accelerating. Supply chains that were taken for granted are now being revealed as fragile. Globalization is being questioned. Reshoring and regionalization are becoming strategic priorities. In this environment, hard assets matter. Tangible things that cannot be printed or wished into existence matter. Silver is one of those things. It is not the only thing. It is not a magic solution. But it is a real asset with real utility in a world that is becoming more uncertain. And now, just as that uncertainty is rising, the market for silver has become a little bit tighter. That is not a coincidence. That is the way the world works. Constraints tend to appear exactly when they matter most. Let me tell you what the investors I respect are thinking right now. They are not panicking. They are not celebrating. They are simply updating their models. They are asking questions like, how does this change the cost structure for industrial silver users? How does this affect the arbitrage between London and other markets? How does this impact the clearing and settlement process for futures contracts? They are not looking for a quick trade. They are looking at the next 3 to 5 years. They are thinking about allocation. They are thinking about what percentage of their portfolio should be in hard assets versus financial assets. They are thinking about diversification within precious metals. Gold, silver, platinum, each has a different use case and a different risk profile. They are also thinking about liquidity. They know that in a crisis, the most liquid assets are the ones you can actually sell. Physical silver is not as liquid as a stock or a bond, but it is more liquid than real estate or private business. They are thinking about storage. Where do you keep physical silver? How do you protect it? What are the costs and risks? These are not exciting questions, but they are the right questions. Because investing is not about excitement. It is about making informed decisions that protect and grow your wealth over time. Let's talk about where silver fits in a well-constructed portfolio. Silver is not a growth asset. It is not going to double your money in 6 months, and if it does, you should be suspicious. Silver is a store of value and a hedge. It is insurance against currency debasement, systemic instability, and supply shocks. Most financial advisors will tell you that precious metals should represent somewhere between 5 and 15% of a diversified portfolio. That range makes sense. It is enough to provide meaningful protection, but not so much that you are overly concentrated in a single asset class. Within that allocation, you might split between gold and silver. Gold is more stable, silver is more volatile, but also has industrial demand drivers that gold does not. The right mix depends on your risk tolerance, your time horizon, and your view of the macro environment. If you believe we are entering a period of sustained inflation and currency instability, you might lean more heavily into precious metals. If you believe the system will muddle through and financial assets will continue to perform, you might keep your allocation modest. There is no single right answer. The point is to think it through, to have a plan, to understand why you own what you own. You cannot understand the silver market without understanding the broader macroeconomic environment. We are living in a world where government debt has reached levels never before seen in peacetime. Central banks have expanded their balance sheets by trillions of dollars. They have purchased government bonds, corporate bonds, and in some cases, equities. This is not free. This has consequences. One consequence is inflation. When you increase the money supply faster than you increase the supply of goods and services, prices rise. We saw this over the past few years. Inflation surged to levels not seen in decades. Central banks responded by raising interest rates. But here's the problem. The debt levels are so high that governments cannot afford to keep interest rates elevated for too long. The cost of servicing the debt becomes unsustainable. So we are trapped in a cycle. Raise rates to fight inflation, but not too much, or you trigger a debt crisis. Lower rates to ease the debt burden, but risk reigniting inflation. This is the environment we are in. And in this environment, hard assets become attractive. Silver is not going to solve your problems, but it is one of the tools you can use to protect your purchasing power over time. So what happens next? Honestly, no one knows for certain. Anyone who tells you they know exactly what silver is going to do is either lying or deluded. What we can do is assess the probabilities. The probability that physical silver becomes more valuable. Relative to paper, silver has increased. The probability that industrial demand continues to rise has not changed. It may have even increased as green energy initiatives accelerate. The probability that central banks continue to expand money supply over the long term remains high. That is the path of least resistance for governments with unsustainable debt burdens. The probability that geopolitical tensions continue to disrupt supply chains also remains elevated. Add all of this together, and the case for owning silver is stronger today than it was a month ago. But again, probability is not certainty, and timing is impossible to predict. What you can control is your own preparation. You can control your allocation. You can control your risk management. You can control your emotional discipline. You cannot control the market. You cannot control policy decisions. You cannot control when or how this plays out, but you can control how you respond. Let me emphasize this one more time. Patience is everything. The silver market can be frustrating. It can move sideways for months or even years. It can spike and then crash. It can ignore fundamentals for long stretches of time. But over the long arc, fundamentals matter. Supply and demand matter. Monetary policy matters. If you bought silver for the right reasons, then short-term noise should not shake you. If you are considering silver, do not expect instant gratification. Expect to hold for years. Expect volatility. Expect to question your decision at times. That is the nature of real investing. It is uncomfortable. It requires conviction. It requires the ability to think independently and act when others are not paying attention. The investors who do well are not the ones who are the smartest or who have the best information. They are the ones who are patient, who are disciplined, who do not let emotions dictate their decisions. The Greenland Tariff is not a sensational headline. It is a structural shift. It is a quiet disruption in the plumbing of the global silver market. It is a 10% cost increase on a supply chain that was already under strain. Most people will not understand it. Most people will not care until the price starts moving in ways they cannot ignore. By then, the easy opportunity will have passed. If you already hold silver, this is a reminder that your position is grounded in sound fundamentals. Stay patient. Stay informed. Do not let short-term volatility shake you out. If you are considering silver, this is a moment to educate yourself, to ask the right questions, to understand what you're buying and why. This is not financial advice. I'm not telling you to buy or sell anything. I'm simply walking you through what has happened and why it matters. The rest is up to you. Understand the cycles, understand the risks, understand your own psychology, and above all, stay disciplined, stay thoughtful, stay grounded. Because in the end, the investors who succeed are not the ones who react to every headline. They are the ones who understand the deeper currents, who position themselves intelligently, who have the patience to let time and fundamentals work in their favor. That is the game. And now you understand it a little better. Thank you for watching. Stay informed, stay prepared, and I will see you in the next one.